So far we have been discussing that is issue of shares, and then issue of shares is concerned how to collect uh, money from share issues, and also we have already discussed some parts of financial statements of a company. So that under that topic, can you remember we have discussed so far. Now, financial statement of a company. Now, this is the lesson that we have discussed today. And also, so far, I feel that we have discussed a part of that as well. Now, you see, now it is time for us to discuss financial statements one by one. We have to discuss financial statements one by one. Now, here you see the financial statement of an incorporated company, that is statement of profit or loss and other comprehensive income. For the end date, you can put the date here. Now here you have to mention the name of the business or company based on entity concept. Based on entity concept, you have to write the name of the company. Here, based on periodic concept, you have to write the accounting period. And then based on money measurement concept, you have to write the measurement value, or you see that is rupees or cents. Now this is why here I have mentioned as rupees thousands. Now this is the accepted format of an incorporated company, that is comprehensive income statement based on that is LKAS 1. In LKAS 1 means Lanka Accounting Standard number 1. Now keep in mind that based on LKAS 1, this is the given format. Now in the examination, when you prepare income statement, definitely you have to follow this format. If you violate this format, your marks should be deducted in the examination. Now look at first one is that is sales, and then cost of sales should be deducted, and then you can get what you call other incomes, that is other income. Here one is working number 1. You have to here you can take another that is cost of sale, another working can be mentioned, because you see normally here cost of sale is concerned, you can take it out as W1. W1 is working number 1. And then I change this format for a moment. Then you see other income, it can be taken as number 2, working number 2. Then here you see this is the face of the income statement, and then the way you calculate the other income should be mentioned here. Here you are taking only the total of other income. In a separate place, you have to show how this other income total has been calculated. Even the gross cost of sale is concerned, here you are taking the final value, and then you have to calculate the cost of sale in a separate place. Now here distribution income, I am taking it as number 3. W number 3 means working number 3. And then administrative expense, I'm taking it as W number 3 sale. Sorry, W number 3 sale. W number 3 sale. And then other expense, I'm taking another one is that is W1 number 3. And then financial cost, once again, W number 3. Now you have to separately find out each values by preparing a table. Understand? By preparing a table comprising distribution expense, administrative expense, other expense, financial expense. You can take out total of each category of expenses, and then you see you are getting the total of expenses here. Now here gross profit is there, other income should be added, and then total income and gross profit should be taken, and out of this amount you can subtract total expenses of the company within the given period of time. Then you can find out what you call profit before tax. I am taking it as D1, profit before tax D1. D1 means disclosure 1. Now when we prepare the financial statements of a company, there should be some notes and disclosures. Notes and disclosures. Those disclosures should be separately pointed out. You are given separate mark for these disclosures. Now, one disclosure is that profit before tax you have to disclose. And then, you see, company is concerned, definitely, the company has to pay what we call corporate tax. Corporate tax. You see, as the company is a legal entity, having a legal ownership, and it has a kind of separate personality. It has a separate legal personality, so that the company should pay tax by the name of the company. But sole trade business is concerned, it is not having a legal it is not a legal entity. It is not having a legal personality, so that sole trade business owner should not pay tax by the name of the business. Partnership, as well, partnership is concerned, partnership is not having a legal personality, so that partner should not pay tax by the name of the partnership, but company is having a legal personality, so that company should pay tax by the name of the company. So that this is the income tax payment. Income tax payment, then you can take it as W4. I'm taking it as W4. Then you have to find out, you have to show how to calculate income tax expenses for the period. Then income tax expense, and then you are getting profit or loss for the period. Profit or loss for the period. And then definitely, now there is another important part. Just keep in mind, if this income statement is a comprehensive income statement, if you take it as a comprehensive income statement, the meaning of comprehensive, understand, the meaning of comprehensive means, you see here, if it is a comprehensive income statement, definitely now this other comprehensive income should be highlighted and added. Understand? Now, if we are not considering other comprehensive income, this income statement cannot be treated as comprehensive income statement. If we are not considering other comprehensive income, this income statement become income statement of profit or loss income statement only. If you consider comprehensive income, definitely this statement become comprehensive income statement. Now, before 2014, we were not discussing comprehensive concept. Now, from 2014 onwards, we are continuously discussing what we call comprehensive income statement. Now, for advanced level, we are preparing only a comprehensive income statement. Now, keep in mind that comprehensive income means normally for advanced level, income generated from revaluation of property. Understand? Comprehensive income means for advanced level, income generated from revaluation of property. What do you mean by revaluation? What do you mean by revaluation? Revaluation means, you see, estimating the fair value of the asset. Estimate the fair value of the asset, or consider the fair value of the asset. Then now, for example, now just try to understand, you have purchased the land 10 years before. 10 years before, you have purchased a land for 1 lakh. Now, normally you know that land value is normally increasing day by day. Now, based on historical cost concept, land account should be maintained by cost value. Even today, it should be maintained, the land account should be maintained on cost. Now, even today, land value is, that is 100,000 after 10 years. Now, normally, if you sell it in the market, in the normal market, sometimes it can be sold today for 10 million sometimes, or 10 lakhs sometimes. So that if you consider the fair value in the sense that, you see, determining the market value of the asset today, then you purchased it for, that is 100,000. Now today value of the land is 10 or 10 lakhs. So that land revaluation profit, you see, that is 9,000. So that 9,000 profit should be recorded here as other comprehensive income. Not only land, maybe building, maybe motor vehicle, maybe furniture, whatever non-current assets, property plants should be revalued. Now it is said that according to LK 16, property plant equipment standard, you see, a company should revalue or determine the fair value of property plant equipment at least within 1 year, by a professional value, by a professional valuer, at least within 1 year. You see, at least once for 1 year, you see, that is property plant should be revalued by a professional value. So that if there is revaluation profit, the revaluation profit should be treated here as comprehensive income. Now, for example, assume that here revaluation of land profit is 100, that 100 should be added to this profit. Then you are getting what you call total comprehensive income. Total comprehensive income. So that if there is any revaluation loss, sometimes there may be a revaluation loss. If there is a revaluation loss, it should be treated as other expense. It should be treated as other expense. So that keep in mind, if there is any revaluation loss, it should come under the category of other expenses. Revaluation loss means normally, now, just assume that I'll give you a simple example for you to understand. I'll give you a simple, very simple explanation for you to understand. Assume that, very simply assume that, you see, the value of the motor vehicle is 1,000. Value of the motor vehicle is 1,000. So far, you see, this has been depreciated for 2 years. For example, 2 years, this motor vehicle has been depreciated. Now, total of depreciation within 2 years, assume that is 2,500. Now, then you can identify, this is what we call, you are getting 7,500 is the carrying value of the motor vehicle. This is the carrying value. If this motor vehicle can be sold in the open market today, if this motor vehicle can be sold in the open market today, assume that selling price is, that is 8,000. Now, 8,000 is the revalued amount. This is the carrying value of the motor vehicle. This is the revalued value of the motor vehicle. Now, there is a 500 profit on revaluation, because normal, you see, the book value of the motor vehicle is, that is 7,500 book value. But if it is revalued, it can be sold in the market for 8,000. So that 5,000 is treated as the revaluation profit. Another example, assume that this motor vehicle can be sold in the open market, which is what we call the fair value or the revalued value, that is for 7,000. Then you see, if it is sold in the market for 7,000, then you see this is a loss, 500 loss. That loss should be treated as other expense. Now, this is how we have to identify revaluation loss or profit. Now, if there is any revaluation profit on land or building or motor vehicle or any property plant equipment, it should be treated here as other comprehensive income. And then if there is any revaluation loss on property plant equipment, it should be treated as other expense, under the category of other expense. Now, this is how we have to understand revaluation. No matter when we are continuing the lesson, you can understand how to revalue asset, what are the relevant principles of revaluation. All these can be identified. And then you see, you are getting the total comprehensive income. This is what we call total comprehensive income. This is the income for the period. Right. Now let's move on to a simple one. I'll show you awareness, kind of awareness. Now I'll give you simple examples to be done so that you can understand well. Now here you see, please turn to test 8. Here test 8. Following are the expenses and income items of Rovini PLC for the year ended 31st May 2021. Now these are the expenses and incomes of the business, Rovini PLC. You are asked to prepare comprehensive income statement for the year ended 31st 2000, sorry, it should be 2018, sorry, it should be 2021. Here it says spelling mistake. 31st 2021, and disclosures and notes. Let's get it. I'll show you another part of that. Now here you see, I'm showing you my handwritten note on that. Normally, yes, look at this. Now this is the Rovini PLC. Now this is how you have to prepare the format. This is how you have to prepare the format of a income statement of a company. Now I'll describe you while drawing it up. Now look at that Rovini PLC based on entity concept. You are right as Rovini PLC based on money measurement concept. Based on money measurement concept, you are right as ₹1000. Based on periodic concept, you are write it as profit or loss and other comprehensive income statement for the end 31st 3/2021. 31st 3/2021. Here sales, write it as here. You can write values here. No, sales value can be written here. Sales. And then cost of sale. Cost of sale. Cost of sale. Here, drop a small, you see, space to calculate the cost of sale. It is very easy for the examiner to examine your paper, so that it is better for us to give all these workings cleanly and separately. That is why I wanted to show you how to prepare this working part. Now here, cost of sale. Now normally you know that in a sole trade maybe, partnership maybe. Here when we prepare the cost of, calculate the cost of sale, opening stock, and then purchases, all these items are there. But you see, these are the face values. These are called face values. Now here only we take only the total of that cost of sale. Now, here we show how to calculate the cost of sale. So that please take a separate part, you see, as a triangular and small statement for you to understand or calculate cost of sale. Now, this is what cost of sale, and the total of value should be taken here. Now, after calculating the cost of sale, here you are getting the cost of sale. That amount should be taken here as the total one, as a total. Then you are getting gross profit. Then you are getting gross profit. After subtracting cost of sale from sales, you can get gross profit. And then other income. You have to calculate other income. Then in a separate, you see part, in a separate statement, very simple one, you can find out the total of other income. Here, take out the total of other income. It is easy for you to manage the things. Here, you see, value should be taken here separately, then we can identify very clearly. The thing is that now you have to understand that the examiner is very interested in the clean as well as proper presentation of the paper. Proper and clean presentation of the paper, so that it is better for you to prepare your paper well arranged as well as proper organization should be there. Right. And then other incomes. Just keep in mind other income. And then total of other income should be taken here. Now, after taking that all other incomes, total should be taken here. Total should be taken here. Yes. And then you see this order should be maintained compulsorily. Distribution cost, working 3. Administrative cost, working 3. Other cost, working 3. Financial cost, working number 3. This chronology cannot be violated because we are preparing the financial statement based on LKAS 1, Lanka Accounting Standard number 1. So that you are prohibited to violate this order. Keep in mind. Yes, here you are taking only the total of distribution cost, total of administrative cost, total of other cost, total of financial cost. And then you have to separately mention the values of these expenses. Now here, this is working number 3. This is working number 3. Now this can be taken as expense table. This can be taken as an expense table. Expense table. In the expense table, you can draw 4 columns: distribution expense, administrative expense, other expense, financial expense. Here you can write the item, and if that item is related to distribution column, you can take it as distribution. If this item is related to distribution, you can take it. If this item is related to administration, it should be recorded under the category of administration. If it is related to, if the item is related to other expense, it should be recorded here. If the item is related to financial expense, it should be recorded here. And then in the end, you are getting the total. In the end, you are getting the total. And then you have to calculate the total here. You can, you see, at least you take here 10 lines downward, 10 lines, because there are a number of expenses in the sum. 10 or 12 lines. Now, total of distribution expenses, total of, here you can understand, total of distribution expenses, total of distribution expenses, total of administrative expenses, total of other expenses, total of financial expenses. All these expenses should be taken to the income statement separately. Here you can see total of these values should be taken here as distribution expense, as administrative expense, as other expense, other cost, as financial expense. Financial expense. I feel that it is clear for you. Now the last part. Now you are getting all the expenses here now. Here gross profit is there, the income is there, total of these values, and all these are subtracted values, and then out of this total of gross profit and other income, these separate expenses should be subtracted. And then you are getting profit before tax. Profit before tax, disclose one. And then this profit before tax is concerned, this item should be disclosed here as well. Here you see profit before tax. Take out this table, profit before tax. This should be disclosed, very important in the examination. Definitely you are getting 2 marks for this area. Separate 2 marks are allocated this area. Profit before tax. I'll show you the items that should be recorded here later. Profit before tax. Then after identify profit before tax, then you are getting what you call tax for the period. Profit before tax, tax for the period. Here tax should be subtracted. Tax should be subtracted. So that as tax is subtracted, then the way you calculate tax should be mentioned here. Only 3 or 4 lines enough. Only 3 or 4 lines enough. Here, this is how tax is calculated. Now, the very simple thing is that now in the examination, now if you show these workings very clearly, separately, it is very easy for the examiner to identify all these values. So that my argument is that here you see when you are preparing, just remember, keep in mind, will in the examination, accounting paper 2, first question is based on company account. Accounting paper 2, first question based on company account. You see, carries 40 marks. Carries 40 marks. Definitely for this company account, compulsory question, 40 marks. It carries 40 marks. So that if a student get frustrated over this question due to his inability to do this sum, completely they become frustrated in the paper. So that you should be well organized, well targeted over this question. We considered all this part. Now all the, you see, this is what we call one of the disclosures. Here you can write in this manner. Normally students are writing a note here. This is the note. You can write it down in calculating. In calculating profit before tax. Profit before tax. Tax. Following items were considered. Profit before tax. Profit before tax. Following items were considered. Following items were considered. Understood. In calculating profit before tax, sorry, here in calculating profit before tax, following items were considered. Now keep in mind, this is a kind of disclosure. This is a kind of disclosure. In calculating profit before tax, this sentence is not compulsory, but it is better for you to write. In calculating profit before tax, following items were considered. Now these items are very important. You are getting 2 marks for the examination, separate 2 marks. These workings are concerned, you are not getting separate marks for these workings, but it shows that, you see, now assume that you are here. Now assume that you are here, assume that you are given 2 marks. You are for financial expense, you are given 2 marks. Now here, the exact value should be 65. Exact value is 65. If 65 is available here, you are getting 2 marks. Assume that here, you are getting only, according to your calculation, here you have got only 60. But you are not now getting this 2 marks because it is an erroneous value. So that you are losing this 2 marks due to this wrong calculation. Now examining the what you call workings of financial cost. Now here he considers financial cost. Now assume that here leasing interest is there. Leasing interest here, financial value, leasing interest, that is 30. Now here you are given single mark. For example, you are given single mark, and then here loan interest. You see, you have got only 25. If this value is separately correct, you are getting another mark. And then there are another expense. Assume that OD interest. Assume that OD interest. odd interest, assume that odd interest is, that is 5. Now you get the total of, that is, sorry, odd interest is 5. Now you get the total interest, total of this financial expense column 60. Now this is the 60, but it is wrong. Now the correct value is 65. Now you are not getting this 200, but you see, by looking at the workings, examining the workings, you see marks are allocated for leasing interest 31 mark, loan interest 25 marks. You are getting the total of marks, though you got wrong here. That is why it is very important to show you the workings very correct. Now I feel that it is easy for you to understand. Now we are going to move on to the sum. Yes, sum. Now please turn to the exercise. Take one by one. I'm showing you the format. Now look at the sum here. We are going to record it here. Here, rent income, here, counting expense. There is a mistake here, counting expense.
Yes, sir.
Yes, I'll show you how to record it here. First, normally we have to start with additional information. We have to start with additional information so that just keep in mind here. You see that first one is concerned cost of inventory 31st 2000. It should be 2021 was 3500, and net realizable value of the stock is that is 300. So that here you see in calculating cost of sale, you see as the closing stock, this amount should be recorded. This 3500 should be recorded as a closing stock, and then closing stock, you see when you prepare the calculate the cost of sale, here 3500 should be taken as the closing stock, and then just keep it mind will. Now here 3500 is the cost, 300 is the net realizable value. Difference of 200 should be treated as the stock loss, should be treated as the stock loss, so that it should come under the category of other expense in the expense table. Other expense in the expense table. You have prepared an expense table. In the expense table, you have to take this 200 as other expense. I feel that it is okay for you. Tax for the period is 1/5 of the profit before tax. Still, we have not calculated the profit before tax. So that is still we are unable to find out the tax amount. First, you have to complete the income statement, and thereafter you can find it out. Yes, now let's move on to the beginning of that items, one by one discussion. See whether your answer is okay. Sales in the income statement phase, you can take it as 40,600. Without taking it to the column, you can take here, because you see sales return is there. Here there is a sales return. So that in the income statement, you can write here, without taking it to the column, you can write here 40,600 minus here sales return is 600. Then you can take the total as the 40,000 to the column of the sales in the income statement. In the income statement, the 40,000 can be taken to the column after deducting this amount. Then purchases, working number one. Purchases, working number one. Stock, opening stock, working number one at the top of the working. You see at the top of the working number one, stock, opening stock, here purchases under that. Carries in under that purchase, carried in under that purchase in the calculation of cost of sale. Sales return should be subtracted here, no matter. Purchases return should be subtracted from purchases. Or under carries in, you can write that value as within bracket, emphasizing subtraction. Purchases return. Motor vehicle disposal profit. That is working number two, other income, under the category of other income. Rent income, under the category of other income, working number two. bank deposit interest, other income under the category of working number 2. Salary and wages in the expense table, administrative expense. Accounting expense, administrative expense. Impairment loss on receivable, that is very simply bad debt. Simply bad debt. Impairment loss on receivable. Distribution expense. Distribution expense. Distribution expense. Here loan, it is not loan expense. Under the category of financial expense. Stock donation, other expense category. Director's salary, administrative expense. Audit fee, administrative expense. Sales guarantee, 140, distribution expense. Sales guarantee. Building depreciation, administrative expense. Building depreciation, administrative. Distribution vehicle depreciation, distribution expense. Eco-test fee, distribution expense. Telephone, electricity, administrative. Advertising, distribution expense. Leasing, financial expense. It's in financial expense. EPF, Employee Provident Fund, and ETF, Employee Trust Fund. Both Employee Provident Fund and Employee Trust Fund are administrative expense. Administrative expense. Other administrative expense, definitely administrative category. Other distribution category opening balance. Other financial opening balance, financial expense. First time revaluation profit on land, it should be on land. First time revaluation profit on land. Now that 2000 should be recorded here. 2000. Here you see revaluation surplus on land here. Revaluation surplus on land and other comprehensive income. Right. Now take the total of this working number 1, cost of sale, and the total should be considered and taken here. Taken here. Other incomes, total should be taken here. And then you see the other party is concerned. Now, here already you have calculated total of distribution expense. Total of distribution should be recorded here. Total of administration should be recorded here. Total of other expenses should be recorded here. Total of financial expense should be recorded here. If I record all these values, then find out the profit before tax. Profit before tax. And then you can take out the tax value. Out of the profit before tax, 1/5 is the tax. 1/5 is the tax. You are getting a value of tax. Tax should be subtracted. Out of the profit before tax, tax should be subtracted. After subtracting tax, you are getting what you call profit for the year. Profit for the year. Here, profit before tax. Here, tax should be subtracted. Tax should be subtracted. Then you are getting profit before tax. Profit before tax. And then you have to, profit before tax minus tax, then you are getting profit for the period. Profit for the period. And then other comprehensive income 2000 is there. Other comprehensive income, that is land revaluation surplus, 2000 is there. Then you have profit for the period and 2000 should be added, and then you are getting total comprehensive income. Total comprehensive income. I'm considering another important part. Now look at what are the items that should be taken for profit before tax. What are the items that should be taken for profit before tax? Now you know that there is a special disclosure here. Special disclosure here, profit before tax. Here, this is the part of profit before tax which is very important. You are getting a separate mark for that. This area is concerned, profit before tax is concerned, you are getting 2 marks. Then what are the items that should be recorded in the profit before tax? We have to consider the items. I'll show you how to find it out and determine the values that you have to record here. Right, now this is how you have to identify. Now, here definitely, you see, now in a business, in the company, there are normal operating expenses. See whether you are able to understand. There are normal day-to-day operating expenses. And there are some expenses sometimes. These expenses are determined by the board of directors. These expenses are determined by the board of directors. And then in a company, the most important thing is that in a sole trader, manager as well as the owner both are same. Manager, owner both are same. In a partnership, manager, owner both are same. But in a company, incorporated company, management is separated from the owners. Owners are the shareholders. Management is appointed by the vote of the shareholders. So that all the shareholders are not actively participating to the management. On behalf of all the shareholders, only a few number of people are selected as the board of directors. So that, you see, decisions are made by the board of directors. So that there are some decisions completely depending on the board of directors. Sometimes there may be some malpractices as well by taking decisions. So that, you see, that as owner, shareholder needs to know the exact expenses, proper expenses that they have incurred over the business activities. So that, you see, there should be an analysis of expenses that they have considered when they prepare the or calculate the profit. So that all extraordinary, maybe extraordinary expenses maybe. And there are some expenses which are not having cash flow. When we prepare the income statement, there are some expenses that we have considered which are not having a cash flow. For example, here, I'll show you what are the items which are not having cash flow. Now, impairment loss on receivable or bad debt. Bad debt is concerned, impairment loss in receivable is concerned, there is no cash inflow or outflow, but it is still considered as an expense when preparing financial statement. And then you know that building depreciation is not having a cash flow. Though it is not having a cash flow, we have considered it for calculating profit. And then distribution vehicle depreciation, no cash flow, but we have considered. Then you see, and there are some items such as which are not having a cash flow. So that these items should be, you see, separately revealed as disclosed. So that items are not having a special cash flow. And there are some, you see, now, so that just keep in mind, I'll show you the items that should be, you see, recorded under the category of profit before tax. Now, depreciation should be recorded, PD depreciation should be recorded, and then increment should be recorded as profit before tax. Because the reason is that these are not having a cash flow, though they have been treated as expense. There are some items expenses that can be determined by the board of directors sometimes. These are not sometimes extra, you see, operational expenses. Such expenses should be revealed. I show what are such expenses are there in this table. You see, expenses which are directly determined by the board of directors. Now, for example, accounting expenses. Accounting expenses, because you know, accounting expenses means sometimes you see a payment may be paid to external parties for preparing their expenses. Understand? For preparing their accounts, they may have paid certain amount to the external parties, so that this accounting expense can be changed according to the views of the manager, so that they should be known by the owners, shareholders, so that accounting expenses should be revealed as disclosed. Impairment loss should be recorded, disclosed, because there is no cash flow. Loan interest should be revealed. The reason is that different banking institutes, different financial institutes are supplying loan for different interest rate. So that sometimes you see this, you see the from which bank the loan can be taken is determined by the board of directors. So that if any interest is paid on loan interest should be revealed or disclosed, because it can be changed by the board of directors. It is not a normal day-to-day operating expense. Stock donation, special item. Stock donation, because it is a decision taken by the management. It should be known by the shareholders, because as a manager they have taken a decision, but you see it is affected to the shareholders, owners of the business. Though it is an expense, no matter, it should be disclosed. Director's salary. Director's salary can be decided by the board of directors. Their own salary can be decided by themselves, so that they should be revealed. They should be known by the owners as outside owners of the business, so that director's salary should be disclosed. Audit fee. You see, the accounts can be audited by the company, getting the help of various audit firms. You see, this audit fee can be changed according to their decision. You can select, you see, the board of directors can select a board of auditors. According to their selection, audit fee can be changed, so that it is not a normal operating expense, so that it should also be revealed as disclosed. Sales guarantee. Sales guarantee in the sense that, you see, guarantee is given to the, you see, customers. Guarantee is given to the customers. You see, when guarantee is given to the customers, sometimes in the open market, the price may be higher. Price may be higher. But according to their guarantee, they have to sell the customers for less price, and they have to suffer some loss. That loss is suffered due to management decision. When sales guarantees are given to customers, though the market value of that good increases, the business is unable to sell it for high price, because they have given guarantee. So that when selling price is increased in the market due to sales guarantee, the business has to sell them to low value, and there is a loss over this. So that if that guarantee is given, it is a management decision, so that it should be disclosed. Depreciation, no cash flow should be revealed. No cash flow should be revealed. Now, eco test, it is not a day-to-day expense, once and year. So that is special item. It is not a day-to-day operation expense. Should be revealed.
What's an eco test?
Eco test in the sense that, you see, now vehicle owners, they have to once for a year, they have to get what we call the eco emission test. Emission test. It should be revealed. Now, here leasing interest. It can be changed according to leasing institute, leasing company. Interest rate can be changed according to leasing company. so that it can be decided by the board of directors, so that it should be reviewed. And EPF, Employee Provident Fund, Employee Trust Fund. You see, in the company, there may be employees who are entitled EPF and who are not entitled. So that exact value should be known by the owners or shareholders, so that EPF and ETF should be reviewed. EPF and ETF should be reviewed. Then that's all. Now look at that cost of inventory 31st 2021 is, that is 45,000. Now net realizable value of the said stock is, that is 30,000. So that when calculating the cost of sale, 450 should be recorded. 450 should be recorded. I feel that it is better to write 450,000 because sometimes 450 is not enough. It gives some absurdity, so that why don't you start another record another zero here? Another zero, it is easy for us to manage them. Then closing stock is, that is 450. Then net realizable value is 300. Now this 450 should be recorded under closing stock under the category of when calculating cost of sale. Understand? 450 should be subtracted when calculating cost of sale. And then this 300 should be, if you are preparing financial position statement, 300 should be recorded in the financial position. Now difference between 450 and 300, difference is 150. Now difference is 150, that 150 should be recorded as other expense. And also this 150 should be treated as other expense, as well as it should be recorded under the category of profit before tax. It should be recorded under category of profit before tax. Estimated tax for the period 2021, 2020 and 2021 was 300. Tax provision, I'll show you how to prepare the tax account. I'll show you simple tax to tax account. Now, just try to understand this tax account. Here you see, I'm showing you two types of tax accounts. Here, first one is tax. Now here, previous tax year, taxable year. Now I am here relating it, emphasizing it as tax. Look at that tax. Please, when you do it, you can prepare it. That is 19 and 20. Now this is the previous tax year. Now tax for this year. Tax for this year's tax year. That is tax for 2020 and 2021. These are the two related periods. Now this is the previous year and related tax. This is the present year or current year. Now according to given details, estimated tax for 2020 and 2021 was, that is 300. It should be recorded here. 300 should be recorded here as tax. Here PA. It should be recorded as PA. PA, profit or loss statement. Now this is the, now double entries, profit or loss statement debit. Profit or loss statement debit. And then tax account credit. This is how it should be recorded. Now, if I show you the place, this is how you have recorded. Now, here in the income statement, here tax for the period, here you can write it as 300. Income tax for the period, here you can write it as 300. Then now income statement debit 300 here, and then tax account credit. This is how you have recorded credit. Now next one, tax provision for 2019 and 2020. The tax provision should be recorded here. This is the opening balance. Opening balance tax. How much is that? Tax provision is 350. In the previous year, when we prepared the financial income statement, we have provided 350 tax for this year. We have estimated the tax 350. But you see, tax paid for 2020. We estimated previous year, sometimes we pay this year. We pay tax this year. Now, this is the estimated amount, but paid amount as cash, how much it is given as 300. Now, this is the estimated profit previous year from the profit. Sorry, this is the estimated tax from the profit from the previous for the previous year. But paid tax for the previous year was, that is 300. Then you see here our provision was there. Then we provided 350, but we had to pay only 300 so that we can close the account. How can we close the account? Here 350. Here 350. Here also 350. Here also 350. And then here you can see there is a difference that can be treated as PA. How much? 50. 50. Now this is how you have to close that account. Definitely, previous tax account should be closed. Now you can understand tax account debit, tax account debit. Here you can see tax account debit, tax account debit. Look at that, tax account debit 50. Here tax account credit 50. Tax account credit, PL debit. Here tax account debit, PL credit. PL credit means this is how you have to show it in the income statement. Now I'll show you how to show record it in the PL account. Here you see, for example, tax expense. You see tax account for this current year, tax account credit, PL account debit. PL account debit, how much? 3,000. Here, previous year is concerned. Tax account debit, income statement credit, how much be? So that closing balance is how much tax for the period should be, that is 250. 250. This is how you have record tax. Now here you see, you can close this account as well now. This account. Then any amount has not been paid this related to this year. So that PL debit, here balance brought down. This amount should be definitely brought down. Brought down. How much? 300. Balance brought forward here. Balance brought forward here. How much? 300. Now this should be recorded in the financial position statement as current liability. This should be recorded under current liability under the current liability category. Is it clear for you?
Yes, sir.
Yes. Now move on to at the beginning. The stock operating no matter, purchases no matter, carriage in no matter, advertising, audit fee. Audit fee is concerned administrative expense as well as profit before tax category. Administrative, profit before tax. Director's remuneration. Director's remuneration means salary. Administrative expense and profit before tax. Administrative expense and profit before tax category. Motor vehicle disposal loss. Motor vehicle disposal loss. Other expense category and profit before tax. other expense category and profit before tax. Built-in disposal profit, other income category. Working number 2, other income category, working number 2. Motor vehicle depreciation, expense distribution, profit before tax item. Profit before tax item, distribution expense and profit before tax item. Investment income, working number 2, other income. Working number 2, other income. Discount received 100. Working number 2, other income. Salary wages, administrative expense category. Loan interest, financial and profit before tax. Financial and profit before tax. Leasing interest, financial and profit before tax. Leasing interest, financial and profit before tax. Sales guarantee. Sales guarantee. Distribution and profit before tax. Sales guarantee, distribution and profit before tax. Electricity administrative only. Rent administrative only. Impairment of receivable, distribution and profit before tax. Distribution and profit before tax. EPF, ETF both. Administration and profit before tax. Administration and profit before tax. EPF, ETF. Dividend income discount received both W2 other income. Both W2 other income. Land revaluation surplus, comprehensive income, other comprehensive income category. Land revaluation income, surplus, other income category, other comprehensive income. Stock written off, other expense and profit before tax. Other expense and profit before tax. Sales no matter. Built-in depreciation, administrative and profit before tax. Administrative and profit before tax. Stock donation, other category and profit before tax. Other expense category and profit before tax. And I feel that we did 2 income statement. Now thereafter we are going to discuss equity change. Another financial statement is there. Statement of equity changes. From taking one element by one element. One element after that. First we discuss comprehensive income statement. And thereafter we are going to discuss statement of equity changes. Another financial statement of the group of financial statement of a company. And thereafter we are discussing statement of financial position. And after discussing statement of financial position, we can drop a complete set of financial statements. Now you know that set of financial statement is concerned comprehensive income statement, statement of equity changes, statement of financial position, disclosures and notes. In addition, based on LK 7, we prepare cash flow statement 5. There are 5 components of financial statements. We discuss only one. We have to discuss another 4 financial statements. So that in the next discussion, I'm going to introduce equity changes. I'm going to introduce equity changes, statement of equity changes. statement of equity changes. I'm going to introduce statement of equity changes and how to calculate the values of equity changes, how to record the values in the equity change.